Joining us live from the Chicago Board Options Exchange is independent trader Andrew Keene, who's been trading equity options at the CBOE for nearly 10 years. Also with us, Jim Bianco, president of Bianco Research, which analyzes the global economy and stock and bond markets for institutional investors. He turned bearish on stocks in spring of 2007. That was a good call, obviously. He's now concerned that further Fed easing on top of Japan's recent rate cut could lead to another asset bubble. And Jim, let's start by talking about that, because I've been chatting with the kids here all day about the Fed freight train in the form of
Dad.
Not you, with the kids. What do you think about this? I mean, I was talking today with John Brynjolfsson, who said that tips went parabolic this morning. I mean, it seems to affect pretty much every market.
Yeah, that's exactly what's happening, is that every market is rallying. It's not just a stock rally, it's a gold rally, it's a commodity rally, it's a currency rally, dollar down. As a matter of fact, yesterday, foreign investors didn't even make money in the 200-point rally in the stock market because the dollar went down more than the stock market went up on a percentage terms. The reason you're seeing all of this is that the perception is, with the Bank of Japan yesterday and the Fed, they're going to print a whole lot of dollars and a whole lot of yen, and that where's that money going to go? It's going to go into financial assets, so everything is going up right now. There's only one bad call in this market, and that's 3-month Treasury bills. Beyond that, whether you're in bonds or stocks or commodities, they're all going up right now.
Hey, Jim, is there anything that could reverse this dollar slide?
If the Fed does not do quantitative easing, let's say in the amounts that everybody expects, I think $500 billion is pretty much a given if they come in smaller than that number or maybe on that number. But other than that, I think that the dollar is destined to go down. In fact, Geithner's comments even suggested they want the dollar to go down. It's a dangerous game they're playing right now, and that's the game they seem to be playing, and that's the direction that the dollar's going.
But, Jim, does the seeming inevitability of all of this, does it start to make you uneasy when all of this is going inexorably in the same direction?
Oh, it makes you very uneasy. I mean, if the answer is, or the question is there a contrarian call here somewhere that everybody's so dollar bearish that it has to hit a bottom? Yeah, eventually I think that will be the case. But remember back in the winter, in December, everybody got bearish on the dollar at 145 on the euro, and it didn't bottom till 118 in May. So it can go a long way, even with everybody all wound up on it. So I'm not concerned that if the crowd is against it. It can still continue to go lower.
All right, and Andrew, I want to throw it out to you. Zora just talking about earnings here and the weaker dollar and the impact that that's going to have. What are you guys expecting there on the floor in terms of this earnings season?
Well, earnings cycle starts tomorrow with Alcoa. Alcoa's earnings usually aren't that good for the most part. We have financials, which I'm going to look, at their earnings as well. But, for the most part, I think we're going to have like 50%. For the last couple quarters, we've had 50% beat and, 50% not beat, which I think that doesn't make the market go too much. Our volume's still extremely low, but, maybe volume will pick up a little bit when we get earnings starting tomorrow with Alcoa.
Hey, Andrew, it's Dominic here. One of the things you talked about was this volume idea, right? But in the scheme of the whole, a lot of traders I'm talking to were surprised by yesterday's move, such a massive move to the upside ahead of jobs numbers like today's ADP, tomorrow's jobless claims, and then Friday's non-farm payrolls. Is earnings going to be the only catalyst, or could we see jobs affect the picture as well?
Well, I mean, obviously it's not the only catalyst. We see the dollar dropping every day. That's a catalyst. We see the euro going up. We see gold going up. Now oil's starting to rip higher. So, it's not the only catalyst, but jobless claims tomorrow will be a little important. Everybody's waiting until Friday. So I think tomorrow when the jobless claims come out, we'll have a little bit of movement. I think we'll be slow for the rest of the day, waiting for that big number on Friday.
Hey, Andrew, technically there's no stopping in theory until about 1200. Could just be the trickle up. I mean, is that how you play? You just keep a hand on the long side and let it kind of ride up?
Well, you can't fight the market right here. You can't be short. I haven't been short. I try to find a reason to get long. On Monday, we had the biggest down day we've had in 4 weeks, and the SPUs were down 8 or 9 handles. So obviously the trend is up. I don't think we're in a bullish market, but I think the trend is higher. On Monday, we had every reason to collapse. We were down as many as 15 handles in the SPUs, and if you look at it in the last half hour, there was a lot of buying. Ended up only down 8, and it just tells you that the market wants to go higher, and so does gold.
Hey, Jim, you see the momentum as going up, right? And you say the market never stops on a round number. We're getting close to 11,000 here in the Dow. You think it's just going to march straight on through?
Yeah, at this point you'd have to think so. It's only 60 points away. It's a very rare thing that we stop on round numbers, as you just pointed out, and we can continue to go higher. And as I said before, as long as the perception is the Fed's going to be making dollars, those dollars have to go somewhere. and one of those places will be the stock market.
So, Jim, does that make Friday's jobs report less important? As we all know, if you've got a market that's going to go up no matter what, it sort of tends to interpret data a little bit differently than in a down market. Do you think that sentiment has turned to such a degree that even if we get a bad number on Friday, somehow investors will be able to interpret it positively?
Yeah, I think it does make it important only on the positive side. You're right. If we got a big up number, it could maybe quell the idea that we're going to get a big quantitative easing. A neutral to weak number will be viewed as, business as usual. The Fed is going to print money. And we'll do our best to try and explain away a big up number if we get one. But you're right. We're going to try and interpret all the numbers right now as a reason for the Fed to continue to do more quantitative easing, because that seems to be the trend we're going in and what everybody wants right now.
So, Jim, you're saying then if we get a big up number, that could actually be negative for stocks because it reduces the chances of strong QE?
Yeah, it's asymmetrical. A big up number would be a big negative because it reduces the chances of QE. But a big down number, I don't think would be equally as positive because we already expect the Fed to print money. So if we get a big down number, it's not going to do anything to really change our perceptions on it because we already have that built in.
Bottom line, though, you don't care so much. I mean, I think I heard Tom Keene today on Midday Surveillance saying, I promise not to ignore Friday's jobs number. I mean, everybody is just looking out for this Fed freight train, and these what normally are big things turn into little things now.
Yeah, we'll have to pay attention to all of these things because until the Fed makes the announcement, here is QE2, this is what it's about, we have to be concerned that there will be something that comes along that derails it. I mean, I'm operating under the assumption that it's going to happen. It's going to happen at least $500 billion, if not larger. And right now, the only concern you'd have is something that would stop that, not something that would cause them to do it, because it seems like they're ready to do it right now.
Hey, Jim, the chairman of the New York Fed's market desk, the guy who actually goes out and takes action in the market, has commented that Fed action getting in the market has pushed prices up, he says, and it's actually encouraged or it's helped the wealth of households. I mean, he's telling you they're lifting prices. What happens when they stop?
The wealthy health of households, right?
Yeah, exactly right.
Regular people, maybe it hasn't helped.
That's right. But I mean, what happens when they stop? Are we creating the ultimate bubble, and how long can this thing go on?
That's exactly the concern that I have. That was Brian Sack who said that when everything starts to go higher, they're hoping that there will be a wealth effect. The Fed can print money. The Fed can force financial markets and commodity markets higher. Will that create jobs? Will that create aggregate demand? Will that create GDP? No one's sure on that, and I would even go as far to say it probably won't. If it doesn't, if it just produces higher stock prices, but no more jobs and no more growth, then you start looking at something that looks like and smells like a bubble. If they can produce this money and produce more growth, more jobs, then the valuations would be more justified. So we'll have to see if it affects the real economy in addition to the financial market.
Well, that's a good point. In talking with Professor Stiglitz today, I mean, he makes that point that what the Fed's doing isn't historically how it used to work. It's not working in this situation, and it's not going to pay off in terms of creating that aggregate demand. I mean, really, Jim and Andrew, let's bring you back, too, as well. I mean, it really comes down to job creation. Until we start to see some kind of strong job growth, none of this really changes. This cycle continues, correct?
Well, obviously, unemployment is the last indicator that the economy is, fully corrected. Manufacturing numbers have all been good for the most part. All our data has been really good. Housing starts have been good. Everything's been good besides the unemployment and the jobless claims. This is the last indicator to make the market go even that much higher. But, we have to wait for QE2, see what happens. We have to see what happens for these earnings. The earnings are not supposed to be, the expectations are very low for the earnings. So the earnings should be good for the most part. We do have light volume, so I'm a little skeptical. I'm always skeptical, but it does look like we want to push higher and go to 1,200 in the SPX.
I think
we're speechless. we don't know.
It's so amazing, Andrew.
No, we've got a few seconds left. Jim, you want to chime in your thoughts in terms of what Andrew just had to say?
Yeah, I think that, of course, the earnings season is going to matter quite a bit, but that's also going to be largely third quarter numbers, and we expected that the third quarter was a little bit softer than the second quarter, which is why we're talking about QE. So I don't think that the earnings numbers are going to turn the Fed around as much. The market's really focused more forward on this idea that quantitative easing's coming, and will it help the economy?
Right. All comes down to that. Hey, Jim Bianco, thank you so much. Andrew Keene out there in Chicago, our thanks to you as well. We're going to take